delay anything beyond September 1st, so it looks like those are going into effect, absent any other news. And the market's handled that with relative equanimity. The China comments helping out this week. But yeah, there are a lot of minefields going forward, and interest rates are still remarkably low. Even though the stock market has popped up a lot, you still have the 10-year yield at about 1.5. You still have the yield curve inverted, which many people are poo-pooing and suggesting is not a recession indicator this time around. I would disagree. And then there's, still other things going on with Brexit, as we've seen, a suspension of Parliament, something that is not a regular occurrence in Great Britain and presents problems for the EU.
Burns, the way it's been discussed lately with yields hitting record lows or near record lows and the stock market near record highs is that somebody's got it wrong. Is that the case necessarily? Are the stock and bond markets telling two different stories?
That's absolutely the case. You have a bond market that's really is bracing for recession, and with stocks doing very well, there's the typical mindset whenever you do have a divergence is that people say, well, the bond guy, they're the math guys, and they're probably the ones that are going to be correct. But in this case, I think that you do have the signal that's been the signal that the inversion shows has been muted a little bit by a couple of factors, one of which is this is one of the first inversions post-quantitative easing. And so term premiums are less, and it doesn't take as much to invert it. And then the second factor being is that the bond market has become much more global in nature. So in many ways, the interest rates in the U.S. don't necessarily fully reflect what's going on with the economy here as much as they're just tethered down by ultra-low rates elsewhere.
They're the math guys, Ron, in the bond market, not like the stock market, know-nothing that...
They don't do much math.
But I can do the math enough to know, okay, the dividend yield of the S&P 500, as we saw this week, went above the 30-year long bond. The interesting thing about it, the last time it happened, is it was not 2006 or 2007. It was 2009.
March of 2009.
Correct, which was what? The bottom of the bear market and the start of a 10-plus year bull run.
Yeah, having said that, though, the bond market's signal is reflecting a lot of weaknesses overseas. I mean, the fact that interest rates are negative, $17 trillion worth of global sovereign debt yields negative, has a negative yield, that's not a positive signal. I mean, people are trying to suggest that there's only money flowing here because it's not flowing there. Well, yeah, that's partly true, but it's certainly not true that that's a positive signal for the global economy.
No question about that. But I think the question becomes, does it necessarily mean that we have to be heading for a recession of some kind just because Germany's almost all there and China certainly has slowed down and Italy's in tatters at the moment?
Nine different major economies are at or in recession.
But does that mean that we follow inevitably?
My base case has been a growth recession. I know people hate that expression, but growing below trend seems to be more the case. Now, third quarter GDP estimates are at or around 2%. That's still not the 3% that the president wants. It's not the 3% that allows the budget deficit to be reduced. It's not the 3% that allows the labor force to grow on a consistent basis.
What do you hold if you're in a growth recession, economy? What does that mean for investors?
Generally, you gravitate towards quality, you gravitate towards defensive stocks. That has been working in some instances, but you certainly...
Maybe working too well.
Well, yeah, but for a reason. I mean, sometimes things happens and it adds up, right? I mean, the crowd's right for a period of time.